50% of Americans between the age of 40 and 44 have less than $12,000 in retirement savings. If you're in your 40s with not enough savings for retirement but want to start investing in the stock market for retirement, then in this video we will talk about the right investment plan that will help you create wealth which will enable a comfortable retirement. And if you're thinking that it is too late now to start investing, then let me put your worries to rest by saying that you still have 20 to 25 years before retirement, which is a long enough time to allow your savings to multiply. Now, in this video, we will talk about how much money you can expect to build for different investment amounts. And in our investment plan, we will address four main questions. Why should you invest in the stock market for retirement? What exactly should you invest in? How to invest? And how much should you invest? My name is Kanak and welcome back to my channel. If you find this video helpful, then please show your support by liking and subscribing to the channel. Compound interest is the magic that makes investing so important because it has a multiplier effect on your money. To explain it in simple words, when your money earns 10% compound interest, it means in the first year your $100 of investment will earn $10 in interest. But in the second year, not only will your principal amount of $100 will earn a 10% interest, but the $10 of interest will also start to earn a 10% return. And if this process of compounding is repeated over a long period of time, such as a decade or two, then the money will multiply manyfold. So to create wealth for retirement, you will need two things. One, a high rate of return, and two, a long period of time. Now let us try to answer why you should be investing in stocks for retirement and why not real estate, gold, cash or bonds. As you can see on your screen, stocks have the highest rate of return over long term compared to all other investments such as real estate, bonds, gold and cash. In terms of investments, real estate has second best returns after stock. So if you are investing for long term, then to maximize your expected returns, US large cap stocks would be the most optimal choice in terms of maximizing your potential returns while minimizing your risks. Now let us talk about the second question. What should you invest in for your retirement? The most optimal investment option that will provide good long-term returns, cost minimal to own, is well diversified, require no time to manage and will outperform most other investments out there is low-cost S&P 500 ETF such as WU and SPY. Both WU and SPY are low-cost S&P 500 ETF, which means they track S&P 500 index, which is an index of largest 500 companies listed on the US stock exchange. Now you might be wondering, shouldn't you be buying mutual funds instead of S&P 500? But let me tell you that more than 50% of actively managed mutual funds give poorer returns than S&P 500. This is a very well-researched and documented topic and was first discovered by Nobel laureate economist Eugene Fama in the 1970s. Secondly, most mutual funds have high expense ratio, which means you will be paying them an annual percentage fee for managing your money, and usually their returns after deducting the high fees results in returns lower than the low-cost S&P 500 ETFs such as WU or SPY. Now coming to the next important question, when to invest and how much money to invest. Most people, including the best-in-class professional money managers, often fail to correctly time the market, which means they fail to correctly predict when the market will fall or when the market will rise. As the greatest investor of all time, Warren Buffett says, it is nearly impossible as well as stupid to try to time the market. So rather than attempting to achieve the near impossible feat of predicting the stock market and losing money, the most optimal investment strategy that will minimize your risk and help you generate wealth over long term is dollar cost averaging. Dollar cost averaging is nothing but investing a fixed amount of money at fixed intervals of time, such as weekly, bi-weekly or monthly. Dollar cost averaging removes the emotional and behavioral biases that negatively affect investment decisions. And it also reduces the risk of purchasing at overvalued prices as it averages out the purchasing price. Coming to the last question, how much money should you invest? Now the money that you must invest will depend on your income, expenses and what kind of lifestyle you are planning in your retirement. So I will present the amount of money that you can expect to get in your retirement for different investment scenarios, which will help you decide what is the right amount you want to pick. Let us start with the lowest investment amount of $500 on a monthly basis. As you can see on your screen, if you invest $500 every month for the next 25 years, and if this money compounds at 6.59% interest rate, then you will end up with $368,000. Now you might be wondering why I picked 6.59% as the rate of return. The reason is because 6.59% is the inflation-adjusted rate of return of S&P 500 over the last 50 years. The key word is inflation-adjusted, which means although the actual returns are slightly higher at 10%, but if you subtract inflation from the actual returns, then we get the inflation-adjusted returns of 6.59%. The value of money decreases with time, so we need to subtract inflation from our calculations to make sure we keep the purchasing power intact. Similarly, if you invest $1,000 each month, you will end up with an inflation-adjusted $737,000, which means whatever you can afford today with $737,000, you will be able to buy the same things 25 years later. Now I have simplified and printed out the results in a table using the calculator. If you are able to save somewhere around $1,500 each month, you will end up with inflation-adjusted $1 million. Whereas if you are able to save about $3,000 each month, you will end up with inflation-adjusted $2 million. Finally, if you want to have $3 million for your retirement, you will have to start saving $4,000 each month. This was a lot of information, so let me summarize everything that I said. If you are in your 40s and if you invest $1,500 each month for the next 25 years in S&P 500 low-cost ETF such as WU or SPY, you will end up with inflation-adjusted $1.1 million by the time you retire at the age of 65. So that's all for this video. If you found this video helpful, please support us by liking and subscribing to the channel.